Hello, CQA judges. We are the Buffalo Management Company, and this is the University of Buffalo undergraduate CQA team. My name is Micheal Cabra, and a part of my team is Bruce Hepel, Cameron Huber, Marianna Kowalewski, and Artlink Green. First, I want to start off talking about our strategy and philosophy. We isolated two factors during the competition: market cap and valuation. For market cap, we went long large cap, and we shorted small and mid cap companies. In terms of valuation, we went long value stocks, and we shorted speculative growth companies. For our first bet, market cap, we believe the trend over the last 10 years of large cap outperforming small and mid cap would continue. We looked at the overall valuation of the Russell 2000 index and found that at the start of the competition, the index as a whole was trading at a 1.52 price to sales ratio. This was significantly above its 25-year average of 1.04 times price to sales, and only 9 basis points off its all-time high of 1.61 times price to sales. Moving on to our second factor, value. We believe the 10-year trend of growth outperforming value would shift due to the rising inflation that was in the market. As you can see in the chart on the right, in times where inflation is greater than 6%, value outperforms growth on a 3-month scale, 6-month scale, and 12-month scale. Now I'll pivot towards Bruce to talk about our portfolio construction.
We constructed our portfolio based on our investment philosophy. And to do so, we created a robust portfolio framework. So we decided to maintain market neutrality across all of our sectors. To minimize risk, we aimed to maintain a balanced long to short weighting for each sector of 2%. We also made a number of sector bets. For IT, we were long mega cap FANG names, and we were short unprofitable software companies. For healthcare, we were long big pharma names, and we were short speculative biotech names. And for our energy sector, we were long oil, and we were short renewable energy. And those are the sector bets we made within those sectors. We also ran a number of screens in order to add companies to our portfolio throughout the competition. Our screens were our applied factors, and those were our cap size, our value, and also analyst sentiment and our short interest ratio were useful in those screens as well. Throughout the competition, we used this framework to add companies to our portfolio, as well as to rebalance our portfolio. So there are 3 factors we used to rebalance our portfolio. The first one was to remain market neutral. If any sector in our portfolio went unbalanced more than 2%, we were balanced. Every week, we needed to stay within compliance. So every week, we rebalanced our portfolio to that metric where we had 40 long, 40 short positions, as well as no position exceeding 5% and dollar neutrality. And our third factor that we used to rebalance our portfolio was to set a stop loss threshold. And for our short portfolio, that was 15%. And for our long portfolio, that was 20%. And now I will send it off to Cameron Huber for our results and returns.
Thank you, Bruce. Now, we'll transition to reviewing our returns and our results of our strategy throughout the competition. As of March 25th, our overall returns came in at 12.96%, beating the benchmark by 13.53%. Our portfolio had a minimal drawdown of -2% during the early first weeks of the competition, while having a high return of 19.48%. After revisiting our first strategy bet, our assumptions about large cap outperforming mid to small cap was correct. As we can see, the S&P outperformed the Russell 2000 by 10.38% over the course of the competition. An evaluation of the second strategy bet demonstrates similar levels of success. Here, we can consistently see high profitable, strong free cash flow companies make up our best performers on the long side. And the reverse can be seen to small to mid-cap companies, with the majority of our strongest shorts residing in revenue, R&D heavy biotech companies. For the duration of the competition, isolated sectors remain market neutral within 2%. These results demonstrate the viability of constructing inter-sector bets while maintaining exposure across all sectors to maximize diversification throughout the competition. And now Art will speak on our portfolio's risk analysis.
Thank you, Kim. I will now dive into the driving forces of the returns on our portfolio. We found diverse results when looking at the attribution of our factor groups. Our top 2 factor groups were style, which yielded an active risk return of 21%, and market sector, which had a return of 18%. Within these factor groups, we were able to develop a clear understanding of the contributions within each factor group that had the highest return throughout the competition. Within our style risk factor group, we found that the top 4 contributors by cumulative return were size, which yielded the portfolio a 1.5% in return, earning yield, which had a cumulative return of 0.6%, momentum, which had a cumulative return of 0.2%, and leverage, which had a cumulative return of 0.1%. However, our bottom 2 contributors factor were volatility and exchange rate sensitivity. Within our sector risk factor group, we found that the top 4 contributors that were consumer, which yielded the portfolio a 0.7% in return, healthcare, which had a cumulative return of 0.5%, utilities, which had a cumulative return of 0.4%, and real estate, which had a cumulative return of 0.2%. Next, I'll go over the Sharpe ratio and beta of our portfolio. As of March 25th, our Sharpe ratio was 1.29, which ranked us 7th in the competition, and our beta, negative 0.22. Based on the results of these metrics provided, we're able to take key takeaways from the competition. I will now pass it on to Marianna for our key decision factors.
Now I'm going to talk about some of our key decision factors. In round 1 of the competition, we saw a 12.94% return. Highlighting some of these positives for round 1, we saw mid-cap biotech ETFs finish down over 17%, benefiting our shorts. And many of our heavily weighted S&P names saw single-digit gains. A negative impact from this round was our renewable electric vehicle shorts hitting our stop-loss threshold. This was due to bullish sentiment in the space with the Rivian IPO and the Tesla Hertz deal. Round 2 of the competition, we saw a loss of 0.09%. Positive impacts in our portfolio this round came from the Russell 2000 sharply selling off, which benefited our short positions. We saw our value stocks outperform, especially the consumer staples, healthcare, and energy sectors. Negative outcomes from this round came from longing financials and tech. In round 3, we had a 0.27% gain on our portfolio due to adding commodities before the Russian-Ukrainian conflict took off, while overweighting healthcare positions continued to rally. Some of our losses came from our negative portfolio beta hurting our returns as the market rallied off of intra-year lows. Our final rankings and results as of March 25th, in compliance, we were ranking in 1st. In terms of returns, we were ranking in 7th, and overall, we came in 4th. Before we end this presentation, Buffalo Management Company would like to thank Dr. Gerber and Jay Schwarzkopf for mentoring our team, and thank you, judges, for your time and consideration in this amazing opportunity.